Here's what social media tells you about trading. Buy low, sell high, get rich, buy a Lamborghini. Here's what they don't tell you. Most of those people are either lying, got lucky once and will lose it back, or are trying to sell you a course. The truth about trading isn't sexy. The basics of trading are actually pretty simple. Yes, mastering it takes time, but understanding what it is and how it works, that shouldn't require a finance degree. But if you actually want to understand how it works, not the fantasy version, the real version, stick around. Let's get started. What is trading? At its core, trading is buying something at one price and selling it at a higher price to make a profit. That's it. You've probably done this before without realizing it. Maybe you bought concert tickets and resold them, or bought a used item and flipped it online. Stock trading is the exact same concept, just with company shares instead of physical items. Trading is different from investing. Investing is buying and holding for years or decades, like planting a tree and waiting for it to mature. Trading is buying and selling more frequently, minutes, days, or weeks, like farming crops for quicker harvests. Both can make money, both have risks, they just operate on different timescales. When you trade stocks, you're buying ownership in companies. Every public company is divided into shares. Buy one share of Apple, you own a tiny piece of Apple. The main things people trade are stocks, ownership in companies, ETFs, pre-made baskets of stocks. An S&P 500 ETF gives you a piece of 500 companies in one purchase. Bonds, loans to governments or companies that pay interest. Options, complex contracts, risky for beginners. And cryptocurrency, extremely volatile, not a good starting point. Focus on stocks and ETFs. They're the foundation. Here at Easy Finance, we turn financial anxiety into financial confidence, one video at a time. So if that sounds good to you, hit subscribe and let's learn together. The absolute basics, your foundation. To trade, you need a brokerage account. Think of it like a bank account, but for stocks. Popular beginner-friendly options include Fidelity, Schwab, Interactive Brokers, or Robinhood. Most are free to open, charge zero commission on stock trades, and offer practice accounts so you can learn without risking real money. You'll need a government ID, social security number, and bank account to get started. The whole process takes about 10 to 15 minutes, and you can usually start trading within 1 to 2 days. Understanding stock prices and quotes. When you look up a stock, you'll see several key numbers. The current price, what it's trading at right now, the open, price when the market opened, the high and low, today's range, volume, how many shares traded, and the 52-week range, the past year's highs and lows. Green means the price is up, red means it's down. The percentage tells you how much it moved. Plus 2.5% means the stock went up 2.5% from yesterday's close. When you buy or sell, you choose how the order executes. A market order means buy right now at whatever price. It's fast, but you might get a slightly different price than expected. A limit order means only buy if it's $150 or less. You control the price, but the order might never execute if the stock doesn't reach it. A stop-loss order means if the price drops to $140, sell automatically. It protects you from bigger losses, but can trigger during temporary dips. Market orders are best when you want in immediately. Limit orders when you're patient, and stop losses for protecting your downside. The most important numbers to know. Every stock has a ticker symbol, a short abbreviation like AAPL for Apple or TSLA for Tesla. Beyond that, you need to track a few key numbers: the current share price, your cost basis, what you originally paid, the current value of your shares, and your profit or loss, the difference between what you paid and what it's worth now. This can be expressed as a dollar amount or a percentage. The goal is simple: buy low, sell higher than you bought. Reading charts, the visual language of trading. What charts actually show you? A chart is just a picture of how the price moved over time. The horizontal axis, left to right, is time. The vertical axis, bottom to top, is price. That's it. Everything else, the patterns, the lines, the colors, is people trying to find meaning in that movement. Charts show you what already happened. They don't predict the future. but they can help you understand market behavior and make better timing decisions. Types of charts. The simplest chart is a line chart. It just connects closing prices with a line, showing the basic rhythm of price movement. The most commonly used is the candlestick chart, where each candle shows 4 pieces of information: where the price opened, where it closed, and the highest and lowest points it reached during that period. Reading candlesticks is simple. The thick part, the body, shows the range between open and close. Green or white means the price closed higher than it opened, buyers won. Red or black means it closed lower, sellers won. The thin lines above and below, called wicks, show how high and low the price went during that period. This tells a story. There was a fight. Sellers pushed it down to $98, but buyers fought back and pushed it up to $105, finally settling at $103. Buyers won this round. Time frames. Now here's something crucial, and this trips up a lot of people. The same stock can look completely different depending on your time frame. Each candle can represent anything from 1 minute for day traders to 1 day, most common, to 1 week or 1 month for the big picture. The trap: a stock might look like it's crashing on a 5-minute chart, but be in a perfect uptrend on the daily chart. Golden rule: always check multiple time frames. What looks scary close up might be totally normal when you zoom out. Imagine a stock price bouncing inside a room. Support is the floor, a price level where a stock tends to stop falling and bounce back up. Resistance is the ceiling, where it tends to stop rising and fall back down. Why? Psychology. If a stock bounced at $100 3 times before, traders remember and buy again at $100, creating a self-fulfilling prophecy. Here's the key. When support breaks, it often becomes new resistance. When resistance breaks, it often becomes new support. These breakouts signal potential big moves in either direction. Trend lines. Which direction is it going? Trends show the overall direction the price is moving. An uptrend means each bounce is higher than the last. Draw a line connecting the lows. A downtrend means each peak is lower than the last. Draw a line connecting the highs. Sideways means bouncing between support and resistance with no clear direction. The golden rule is the trend is your friend until it ends. Don't fight the overall direction. If a stock is in a clear uptrend, don't bet against it. If it's in a downtrend, don't try to catch a falling knife. Volume, the forgotten key. Volume shows how many shares traded during a period, displayed as bars at the bottom of charts. High volume means strong conviction. Lots of people agree with the price move. Low volume means weak move. Here's how to use it. High volume plus price increase equals strong buying pressure that's likely to continue. Low volume plus price increase means weak buying that'll probably reverse. Volume confirms price moves. For example, if a stock breaks resistance on high volume, it's a real breakout. On low volume, it's probably fake and will fall back. Last chart thing, I promise. Moving averages, the smoothed out truth. A moving average is the average price over the last X days. It smooths out noise and shows the general direction. The two most common are the 50-day, medium-term trend, and the 200-day, long-term trend. Traders use them as trend indicators. Price above the 200-day average means uptrend, below means downtrend. They also act as support and resistance. In an uptrend, price often bounces off the 50-day average. The golden cross, 50-day crossing above 200-day, is a bullish signal. The death cross, 50-day crossing below 200-day, is bearish. Reality check: these aren't magic and many signals fail, but they help you see the big picture. A chart might show a perfect uptrend, but if you don't know the company just lost its biggest customer, which happened after the market closed, you're about to walk into a trap. Charts are useful for when to buy or sell. Fundamentals tell you what to buy or sell. Use both together. The honest truth. For beginners, learn to read basic charts, understand trends, and use support and resistance. Don't get lost in complex indicators or pattern trading. Risk management, the most important thing you'll learn. Risk management is more important than finding good trades. You can be right 70% of the time and still lose all your money if you don't manage risk properly. You can be right only 40% of the time and still make money if you manage risk well. The 1 to 2% rule. Never risk more than 1 to 2% of your total account on any single trade. Here's why. If you have $10,000 and risk 20% per trade, 5 losses drops you to $3,277, a 67% loss that requires 200% profit just to break even. With the 1% rule, risking only $100 per trade, 5 losses drops you to $9,510, just 5% down and easy to recover. Small losses that don't kill you are fine. Big losses that wipe you out are catastrophic. Position sizing. How much to buy? Calculate how many shares to buy based on your risk limit. Here's the formula. Decide your risk amount, 1% of your account, set your stop-loss price, calculate the difference between entry and stop-loss, then divide your risk by that difference. Example, $10,000 account, 1% risk equals $100, buying at $50 with stop at $48 means $2 risk per share. Position size equals $100 divided by $2 equals 50 shares. This is how professionals trade. They calculate position size based on risk, not how much they want to spend. Stop losses, your emergency exit. A stop loss is a preset price where you automatically sell to limit losses. Without one, you'll hold losing trades hoping they come back. They often don't, and one trade can wipe out months of gains. Set them below recent support levels at a fixed percentage like 5% or at a price that keeps your loss to 1 to 2% of your account. The hard part is actually honoring them. When it hits, you'll want to give it more time. Don't. Set the stop loss when you enter the trade and stick to it, no exceptions. Risk-reward ratio, only taking smart bets. Before any trade, ask, if I'm right, how much can I make? If I'm wrong, how much will I lose? The ratio should be at least 2 to 1. Potential reward should be twice your risk. Example of a good trade. Entry at $50, stop at $48, risk $2, target $56, reward $6 equals 3 to 1 ratio. You can be wrong 2 out of 3 times and still break even. A bad trade, entry $50, stop $48, target $52 equals 1 to 1 ratio. You need to be right over 50% of the time just to break even, and after costs, you'll lose money. Don't take bad trades because you're bored. Diversification. Don't put all your eggs in one basket. Spread your money across different investments instead of putting everything in one stock. If you put everything in one stock and it crashes, you lose everything. Spread across 10 stocks and one crashes, you lose 10%. Good diversification for active traders is 3 to 5 positions. For long-term investors, 10 to 20 stocks or just buy an index fund. Important, diversification means different sectors and industries, not just different stocks. Bad diversification, owning Apple, Microsoft, Google, Amazon, and Meta, all tech. So if tech crashes, everything crashes together. Good diversification, tech, healthcare, finance, consumer goods, and energy. Trading psychology, why your brain is your biggest enemy. Here's what nobody tells you. The hardest part of trading isn't finding good trades. It's controlling your emotions when real money is on the line. 4 emotions destroy traders. Fear makes you sell winners too early. Greed makes you hold losers too long. FOMO makes you chase stocks that already moved. Revenge makes you take stupid trades trying to win back losses. Here's a typical beginner journey. First trade goes up 5%, you feel like a genius. Second trade drops 2%, your stomach knots. It hits minus 5%, you panic and sell. Then it bounces back 10% after you sold. Rage. You jump into something else to make it back, and it drops 8%. 6 weeks later, you're down 20% and convinced trading is a scam. The enemy isn't the market, it's you. Your brain evolved to keep you alive, not to trade stocks. The solution is a trading plan with clear rules. Exactly when you'll enter, exactly when you'll exit, both profit and loss, and exactly how much you'll risk. When your emotions say, "But this time is different," ignore them and follow the plan. This is what separates winners from losers. Not intelligence or secret indicators, just discipline. Different trading styles. Not all trading is the same. Different styles suit different personalities, time availability, and risk tolerance. Day trading. Buying and selling within the same day, never holding overnight. Requires 2 to 4+ hours daily during market hours and a $25,000 minimum account in the US. Extremely difficult. 95% lose money. Very stressful with high time commitment. Reality check. This is the hardest style. Don't start here. Swing trading. Holding for days to weeks trying to capture larger moves. Requires 30 to 60 minutes daily. More forgiving than day trading and can work around a day job. Still has overnight risk and requires discipline. Reality check. This is the best starting point for beginners who want to actively trade. Position trading. Holding for weeks to months, basically long-term investing with more active management. Requires 1 to 2 hours weekly. Lower stress with potential tax benefits if held over a year. Requires patience and ability to stomach larger swings. Less exciting, but more manageable. Long-term investing. Buy and hold. Buying quality investments and holding for years or decades. Requires 1 to 2 hours monthly. Historically, the highest success rate, lowest stress, most tax efficient. Compound growth does the heavy lifting. Reality check. This is how most wealth is actually built. Index fund investing beats most active strategies over time. For most people, this is the right choice. The real costs of trading. Trading isn't free, even with zero-commission brokers. The spread, the difference between what buyers pay and sellers receive, costs you money on every trade. But the biggest cost is taxes. Short-term trades, held less than a year, are taxed as regular income at 20 to 40%, while long-term holds get preferential rates of 0 to 20%. If you make $10,000 day trading in the 25% bracket, you owe $2,500 in taxes. Your real profit is only $7,500. Many beginners don't set aside money and get hit with surprise bills. There's also opportunity cost. If you break even trading all year, you actually lost money because that capital could have grown 10% in an index fund. Minimize costs by trading less frequently, holding winners longer for better tax treatment, using limit orders, and setting aside 25 to 30% of profits for taxes immediately. The hard truths and final reality check. Before we wrap up, let's be completely honest about some uncomfortable facts. For 95% of people, active trading will cost them money compared to buying index funds and holding. The numbers don't lie. 95% of day traders lose money. 90% of professional fund managers underperform index funds. But 90% of people who buy and hold index funds make money. Active trading makes sense only if you genuinely enjoy the process, can dedicate significant time to learning, have capital you can afford to lose, understand you're competing against professionals, and stay honest about your results. Index fund investing makes more sense if you have a day job, want to build wealth without constant monitoring, value your time, and want the highest probability of success. There's no shame in choosing investing over trading. It's actually the smarter choice for most people. If you do trade, treat it like a business, not a hobby. Businesses require capital, education, systems, record-keeping, and honest evaluation. Most failed traders failed because they treated it like gambling. Let's be real about capital requirements. To learn, you need $500 to $2,000 you can lose completely. To day trade in the US, $25,000 minimum. To swing trade seriously, $5,000 to $10,000. To make a living, $100,000. If you don't have this, focus on building your career, investing in index funds, and paper trading. Focus on process metrics, not results. Bad metrics, I made money this week. Good metrics, I followed my plan on 90% of trades and my average win is 2x my average loss. Sometimes the right decision is to quit. Signs it's not for you: losing money for 12+ months, significant stress, can't follow risk rules, using money you can't afford to lose, not enjoying the process, or having better opportunities elsewhere. Most people who try trading eventually stop. If you quit and invest in index funds instead, that's still a win.
All right, let's wrap this up. What you just learned. You now understand what trading actually is: buying low, selling high, but way harder than it sounds. You know how the market works: simple supply and demand. Everything else is noise. You know your emotions are your biggest enemy, and that discipline beats intelligence every time. Remember, here at Easy Finance, we're turning financial anxiety into financial confidence, one video at a time. Subscribe if you want more honest finance education without the hype. And comment below, are you going to try trading or are you sticking with index fund investing? Be honest, there's no wrong answer. Protecting your money is more important than growing it. Start small, be patient, stay disciplined. Thanks for watching. I'll see you in the next video. The end.